Quick note, this is for educational purposes only and not financial advice. Any decisions you make are your own responsibility, and trading involves risk. Most people overcomplicate trading from the very beginning. They assume it requires advanced mathematics, complex indicators, or some kind of secret knowledge that only professionals have access to. That belief alone creates confusion, hesitation, and ultimately poor decisions. The reality is far simpler than that, and once you understand the core idea properly, everything else begins to make sense. At its foundation, trading is nothing more than the act of exchanging one currency for another with the expectation that its value will change. That is it. Strip away all the noise, all the charts, all the terminology, and what you are left with is a decision. You are deciding whether one currency will become stronger or weaker relative to another. Think about that carefully. Every single trade, no matter how complex it appears on the surface, comes down to that one idea: strength versus weakness. If you can understand what drives that relationship, you are already ahead of most people who enter the market. The problem is that beginners tend to focus on the wrong things. They focus on entry points, indicators, and quick profits, but they do not understand what they are actually trading. They do not understand why a currency moves in the first place. Without that understanding, every trade becomes a guess, even if it feels logical in the moment. This is where a simpler approach becomes powerful. Instead of trying to learn everything at once, the goal is to reduce trading to its most essential components. When you do that, clarity replaces confusion, decisions become more structured, and most importantly, you begin to think like a professional rather than a participant chasing outcomes. Over the next few sections, the aim is to break this down in the simplest possible way without losing depth. Not by removing complexity entirely, but by organizing it properly so it becomes understandable. Because once trading makes sense at a fundamental level, everything else becomes easier to learn, apply, and execute consistently. To understand trading properly, you first need to understand what a currency pair actually represents. When you see something like euro, US dollar, it is not just a random combination of letters. It is a relationship between two economies, two monetary systems, and two sets of expectations about the future. The first currency in the pair is the base currency, and the second is the quote currency. When you buy a pair, you are buying the base currency and selling the quote currency. When you sell a pair, you are doing the opposite. That means every trade is always a comparison, never an isolated decision. This is where many beginners get confused. They think in terms of whether a currency is going up or down on its own, but currencies do not move in isolation. They move relative to something else. So the real question is not whether a currency is strong or weak, but whether it is stronger or weaker than the one it is paired with. Once you understand this, the market begins to look very different. Instead of seeing random price movements, you start to see relative performance. You start to ask better questions. Which economy is growing faster? Which central bank is more aggressive with interest rates? Which currency is attracting more capital? These are the types of questions that actually move markets. Price is simply the result of these underlying forces. And when you begin to think in these terms, you are no longer reacting to price. You are anticipating the reasons behind it. This shift in thinking is what separates structured traders from reactive ones. It is not about knowing everything. It is about understanding what matters and focusing on that consistently. Because once you see currency pairs as relationships rather than numbers, the entire market becomes far more logical. Now that the structure of a currency pair is clear, the next step is understanding what actually drives those movements. Because without that, trading becomes nothing more than reacting to price after it has already moved. At the highest level, currencies move because of capital flows. Money is constantly moving around the global financial system, and it tends to flow towards economies that offer better returns, stronger growth, and greater stability. When capital flows into a country, its currency tends to strengthen. When it flows out, the currency tends to weaken. One of the biggest drivers of this process is interest rates. Central banks control interest rates, and these rates influence how attractive a currency is to investors. Higher interest rates often attract more capital because investors can earn better returns. Lower rates tend to do the opposite, but interest rates alone are not enough. Markets are forward-looking. They care about expectations, not just current conditions. If traders believe that a central bank will raise rates in the future, the currency can strengthen even before that happens. This is why understanding expectations is so important. Growth is another major factor. Strong economic growth suggests opportunity, expansion, and profitability that attracts investment. Weak growth suggests the opposite. So currencies tied to stronger economies tend to perform better over time. Inflation also plays a role. High inflation can weaken a currency if it reduces purchasing power, but it can also strengthen it if it forces a central bank to raise rates. This is why context matters. There is no single factor that determines direction on its own. The key takeaway is that currencies move for reasons. They are not random. And while it may feel chaotic at times, there is always an underlying structure driving those movements. Once you begin to understand that structure, trading becomes far less about guessing and far more about interpreting. Even with a solid understanding of what drives currency movements, many traders still struggle because they approach the market in a fragmented way. They learn bits and pieces of information, but they never connect them into a coherent framework. And without a framework, consistency becomes almost impossible. A framework is simply a structured way of thinking. It allows you to process information in the same way every time, rather than reacting emotionally or impulsively. In trading, this is essential because the market will constantly present new situations, and without structure, every situation feels different and uncertain. A simple framework begins with identifying relative strength. Which currency is fundamentally stronger and which is weaker? That alone gives you a directional bias. You are no longer guessing. You are aligning your decision with underlying conditions. From there, you consider timing. Just because something should move in a certain direction does not mean it will do so immediately. Markets move in phases. There are periods of momentum, consolidation, and reversal. Understanding this helps you avoid entering trades at the wrong time. Risk is the final piece. No matter how strong your reasoning is, you will be wrong sometimes. That is part of trading. A framework ensures that when you are wrong, the impact is controlled. This is what allows you to stay in the game long enough for your edge to play out. When these elements come together, direction, timing, and risk, trading becomes a process rather than a series of random decisions, and that process is what leads to consistency over time. This is where most traders get it wrong. They search for certainty instead of structure, but certainty does not exist in trading. Structure does, and once you build that structure, your decisions become more stable, more repeatable, and far more effective. At this point, the market should already feel more understandable. Not because every detail has been covered, but because the foundation is now clear. Trading is not about predicting every movement. It is about making informed decisions based on relative strength, expectations, and structured thinking. One of the biggest mistakes beginners make is trying to speed up the process. They want to jump straight into execution, believing that experience alone will teach them everything they need to know. But without a solid foundation, that experience often reinforces bad habits rather than building skill. The smarter approach is to slow down and focus on understanding first. When you understand why currencies move, how pairs are structured, and how to apply a simple framework, every trade becomes an opportunity to reinforce good decision making rather than random behavior. This is also where patience becomes important. Markets will always be there. Opportunities are constant. There is no need to rush into trades just to feel active. In fact, the ability to wait for the right conditions is one of the most valuable skills a trader can develop. As you continue building your knowledge, everything will begin to layer together. What feels simple now will become more detailed. What feels uncertain will become more structured. And over time, your confidence will come not from outcomes, but from the quality of your decision-making process. That is the real goal. Not just to understand trading, but to think about it in a way that leads to consistent execution. Because once your thinking improves, your results eventually follow. And this is where the journey truly begins, moving from understanding the basics to applying them in a way that produces real, measurable progress. Once the foundation is clear, the next step is learning how to interpret the market in a way that is both simple and effective. This is where many traders begin to drift back into complexity, adding unnecessary layers that ultimately make decision making harder rather than easier. The objective here is the opposite. It is to refine understanding, not complicate it. At its core, every trading decision should begin with a simple question: which currency is stronger and which is weaker right now? Not in theory, not historically, but in the current environment. This immediately forces clarity. It removes vague thinking and replaces it with a direct comparison. Strength does not come from one data point. It comes from a combination of factors. Interest rate expectations, economic growth, inflation trends, and market sentiment all contribute. You're not looking for perfection in each of these areas. You are looking for alignment. When multiple factors point in the same direction, that is where conviction begins to build. Weakness works the same way. It is not about finding a currency that's collapsing. It is about identifying one that is underperforming relative to others. Even slight differences matter, because the market is driven by relative expectations rather than absolute outcomes. Once you identify a strong currency and a weak one, the trade idea becomes obvious. You align yourself with that difference. You are no longer reacting to price movements. You are positioning based on underlying conditions. This is the point where simplicity becomes powerful. Because instead of analyzing everything, you are filtering information through a clear lens. Does this strengthen or weaken my view? If it does not, it is irrelevant. This way of thinking removes noise. It sharpens focus. And most importantly, it creates consistency in how decisions are made. Because trading is not about knowing more than everyone else. It is about applying what matters in a structured and repeatable way. After identifying relative strength, the next challenge is timing. This is where many traders struggle, because even when the direction is correct, poor timing can lead to unnecessary losses. Understanding timing does not require complexity, but it does require patience and awareness. Markets do not move in straight lines, they move in phases. There are periods where price trends clearly in one direction, periods where it pauses and consolidates, and periods where it reverses. Each phase requires a different level of patience and a different type of decision. If you enter too early, before the market is ready to move, you may be correct in direction, but still lose money. If you enter too late, after the move has already happened, the opportunity may be gone. So the goal is not to be first or last. It is to be aligned with momentum when it begins to build. This is why observation matters. Instead of forcing trades, you begin to watch how the market behaves around your idea. Is it holding its direction, or is it struggling to move? Is it showing signs of continuation or hesitation? These are subtle cues, but they provide valuable information. Timing is not about precision. It is about positioning yourself when the probability of movement is in your favor. And that probability increases when your directional bias and market behavior begin to align. Patience plays a major role here. The best opportunities are not constant. They appear when conditions come together. Waiting for those conditions is what separates disciplined traders from reactive ones. When you combine clear direction with patient timing, your trades begin to feel less forced and more natural. You are no longer chasing the market. You are allowing it to come to you. And that shift alone can dramatically improve the quality of your decisions. Even with direction and timing in place, there is one element that determines whether a trader survives long enough to succeed. That element is risk management, and despite its importance, it is often the most ignored aspect of trading. The reality is simple. You will be wrong. No matter how strong your analysis is, no matter how confident you feel, there will always be trades that do not work. This is not a flaw in your strategy. It is a fundamental part of trading. Risk management is what ensures that being wrong does not become catastrophic. It controls how much you lose when a trade fails, and that control is what allows you to continue trading without emotional or financial damage. A simple approach is often the most effective. Before entering any trade, you define how much you are willing to lose if the idea is incorrect. This amount should be small enough that it does not affect your ability to continue trading. Once that level is set, it is not changed based on emotion. This creates consistency. Every trade carries a defined risk, and over time this prevents large losses from erasing progress. It also removes the need to constantly adjust decisions in the moment, which is where emotional mistakes often occur. Another important aspect is understanding that not every trade needs to be a winner. If your losses are controlled and your winning trades are allowed to perform, you can still be profitable even with a modest success rate. This is a concept many beginners struggle with. They focus on being right rather than managing outcomes. But in trading, managing outcomes is far more important. When risk is controlled, pressure is reduced. When pressure is reduced, decision-making improves. And when decision-making improves, consistency becomes achievable. This is why risk management is not just a protective tool. It is a foundation for long-term success. At this stage, the structure of trading is becoming clearer. You understand direction through relative strength, timing through market behavior, and protection through risk management. The next step is learning how to bring these elements together into a single repeatable process. A process is what turns knowledge into execution. Without it, even the best understanding can become inconsistent, because in the moment, emotions, distractions, and uncertainty can easily disrupt decision making. A simple process begins with analysis. You assess which currencies are strong and which are weak. You form a directional bias based on that assessment. This step is deliberate and structured. It is not rushed. The next step is observation. You wait for the market to behave in a way that supports your bias. This is where patience is applied. You are not entering trades based on expectation alone. You are waiting for confirmation through behavior. Then comes execution. When your conditions are met, you enter the trade with a predefined risk. There is no hesitation because the decision has already been made through your process. Finally, there is review. After the trade is complete, whether it wins or loses, you evaluate the decision, not the outcome, but the process. Did you follow your framework? Was your reasoning sound? This is where improvement happens. When this process is followed consistently, trading becomes more controlled. You are no longer relying on instinct or emotion. You are following a structured approach that can be refined over time. This is how professionals operate, not by chasing outcomes, but by refining processes. Because over time, a strong process produces strong results. One of the most important shifts a trader can make is moving from outcome-based thinking to process-based thinking. This may seem subtle, but it has a profound impact on performance and consistency. Most beginners judge their trades based on whether they win or lose. If a trade makes money, it is considered a good decision. If it loses, it is considered a bad one. But this way of thinking is flawed because outcomes in trading are not entirely within your control. You can make a well-reasoned, structured decision and still lose money. You can also make a poor, impulsive decision and still make money. If you judge yourself based on outcomes alone, you reinforce the wrong behaviors. Process-based thinking changes this. It shifts the focus from what happened to how the decision was made. Did you follow your framework? Did you manage risk correctly? Did you wait for the right conditions? When the answer to those questions is yes, the trade is successful from a process perspective, regardless of the financial outcome. And over time, consistent good processes lead to consistent results. This approach also reduces emotional volatility. You are no longer on a constant cycle of confidence and doubt based on short-term results. Instead, your confidence is built on the reliability of your process. This is how professional traders maintain stability. They understand that individual trades do not define them. What defines them is their ability to execute consistently over time. As this mindset develops, trading becomes less stressful and more structured. Decisions become clearer, reactions become calmer, and the focus shifts from chasing profits to building a repeatable edge. That is where real progress begins. Not in the outcome of a single trade, but in the development of a process that can be applied again and again with discipline and confidence. As the process becomes clearer, the next layer of understanding comes from recognizing how the market behaves on a deeper level. Most traders see price movement as random or unpredictable, but in reality it follows patterns of behavior driven by participation. Understanding this behavior adds another level of clarity to decision making. The market is made up of different types of participants. Central banks, institutions, hedge funds, corporations, and retail traders all operate within it, but they do not act in the same way. Institutions move large amounts of capital and tend to operate based on macroeconomic conditions. Retail traders, on the other hand, often react to price after it has already moved. This difference creates opportunity. When you align your thinking with how larger participants operate, you position yourself on the side that drives the market rather than the side that reacts to it. This does not mean predicting every move. It means understanding the underlying intent behind movement. For example, when a currency strengthens due to improving economic expectations, that move is often supported by sustained capital flow. It is not just a short-term reaction, it is a reflection of changing conditions. Recognizing this allows you to stay aligned with the broader direction rather than getting distracted by short-term fluctuations. At the same time, not all movements are meaningful. Some are driven by short-term positioning, liquidity, or temporary sentiment shifts. Part of developing as a trader is learning to distinguish between these types of moves. That skill comes from experience, but it is guided by understanding. When you begin to see the market as a reflection of participant behavior rather than random price changes, your perspective shifts. You stop reacting impulsively and start interpreting movement with context. And that context is what allows you to make more informed, structured decisions over time. Another important concept that simplifies trading is understanding that the market operates on probabilities, not certainties. This is one of the hardest ideas for beginners to accept because it goes against the natural desire to be right. In most areas of life, being correct is the goal, but in trading, being correct all the time is neither realistic nor necessary. What matters is the probability of your decision being favorable over a series of trades. Every trade you take has an uncertain outcome. Even the best setups can fail. But if your approach consistently places you in situations where the probability is slightly in your favor, those small advantages compound over time. This is why consistency is so important. Not in results, but in execution. If you apply the same structured process repeatedly, your edge has the opportunity to play out. If you constantly change your approach, that edge disappears. It also changes how you view losses. Instead of seeing them as failures, you begin to see them as part of the distribution of outcomes. Some trades will win, some will lose, but the overall result is what matters. This mindset reduces emotional pressure. You are no longer trying to control every outcome. You are focusing on maintaining a positive expectancy over time. Understanding probabilities also reinforces the importance of risk management, because even with a strong edge, a series of losses can occur. Without proper risk control, those losses can become damaging. When you fully accept that trading is a probability game, your approach becomes more stable. You stop chasing certainty and start managing uncertainty. And that is a critical shift in becoming consistent. One of the most overlooked aspects of trading is the role of expectations. Markets do not move based on current conditions alone. They move based on how those conditions compare to what was expected. This means that even positive economic data can lead to a currency weakening if the market expected something better. Conversely, negative data can sometimes lead to strength if it is not as bad as anticipated. Understanding this dynamic helps explain why markets sometimes behave in ways that seem counterintuitive. It is not that the market is irrational, it is that it is reacting to the difference between expectation and reality. This is where many traders struggle. They focus on the data itself rather than how that data fits into the broader narrative. But the narrative is what drives positioning, and positioning is what drives price. For example, if traders expect a central bank to raise interest rates aggressively, that expectation may already be reflected in the currency's strength. If the central bank then delivers exactly what was expected, there may be little additional movement. But if expectations are not met, the reaction can be significant. This is why understanding context is so important. You are not just analyzing data, you are analyzing how that data interacts with expectations. When you begin to think in these terms, the market becomes more logical. You are no longer surprised by movements that seem contradictory. Instead, you understand that price is always adjusting to new information relative to what was already anticipated. This level of understanding adds depth to your analysis without adding unnecessary complexity. It allows you to interpret movements more accurately and align your decisions with how the market actually operates. Another layer of simplicity comes from recognizing that not all market conditions are the same. One of the biggest mistakes traders make is applying the same approach regardless of the environment. But the market is dynamic and your approach must adapt accordingly. There are broadly different types of conditions. Sometimes the market is trending, where price moves consistently in one direction. Other times it is ranging, where price moves within a defined area without clear direction. And occasionally it becomes volatile and unpredictable due to major events or uncertainty. Each of these environments requires a different mindset. In a trending market, the focus is on aligning with direction and allowing trades to develop. In a ranging market, patience becomes even more important as opportunities are less clear. In volatile conditions, risk management becomes the priority. Understanding the environment helps you avoid forcing trades. If the market is not offering clear opportunities, the best decision may be to wait. This is often difficult for traders because there is a tendency to equate activity with progress. But in reality, progress comes from making high quality decisions, not frequent ones. Waiting is not inactivity, it is discipline. Adapting to conditions also reinforces the importance of flexibility within your framework. Your core process remains the same, but how you apply it may vary depending on what the market is doing. This awareness reduces frustration. Instead of feeling confused by changing behavior, you begin to recognize it as part of the market's natural rhythm. And once you understand that rhythm, your decisions become more aligned and more effective. At this stage, trading should feel significantly more structured than it did at the beginning. What once seemed complex is now organized into clear components: direction, timing, risk, behavior, probabilities, expectations, and environment. The final step in simplifying your understanding is bringing all of this together into a single cohesive mindset. Because while each concept is valuable on its own, real progress comes from how they interact. When you look at the market, you are no longer searching for isolated signals. You are assessing a combination of factors. You are asking whether the direction makes sense, whether the timing is appropriate, whether the risk is controlled, and whether the environment supports your idea. This creates a layered form of thinking. Each layer adds confidence not through certainty, but through alignment. The more factors that align, the stronger your conviction becomes. At the same time, you remain aware that no setup is guaranteed. This balance between confidence and humility is essential. It allows you to act decisively while still respecting risk. This is where simplicity reaches its highest level, not by reducing trading to something basic, but by organizing complexity into something manageable. You are no longer overwhelmed by information. You are filtering it effectively. As this mindset develops, your approach becomes calmer, more focused, and more consistent. You begin to trust your process, not because it is perfect, but because it is structured and repeatable. And that is what ultimately allows traders to move from confusion to clarity, from inconsistency to discipline, and from uncertainty to controlled execution. As understanding deepens, one of the most valuable skills you can develop is the ability to filter information. The financial world produces an overwhelming amount of data every single day. News releases, opinions, forecasts, and commentary are constant. Without a clear filter, it becomes very easy to lose focus and start making decisions based on noise rather than substance. The key is recognizing that not all information carries equal weight. Some data directly impacts currency value, while other information is largely irrelevant. Professional traders do not consume everything. They prioritize what matters. At the top of that hierarchy are factors that influence capital flows, interest rate expectations, inflation trends, and economic growth sit at the center. These are the drivers that shape longer-term currency direction. Everything else sits around them. This does not mean ignoring news entirely. It means interpreting it through a structured lens. When new information is released, the question is simple: does this strengthen or weaken the current view? If it does not meaningfully change that view, it can be ignored. This approach prevents overreaction. Many traders fall into the trap of constantly adjusting their bias based on short-term headlines. This creates inconsistency and confusion. By filtering information properly, your analysis remains stable. Clarity in trading often comes not from knowing more, but from knowing what to ignore. When your focus narrows to the factors that truly drive the market, your decisions become cleaner and more confident. This is a subtle shift, but it has a significant impact. Because once you remove unnecessary inputs, your framework becomes easier to apply, and your thinking becomes far more precise. Another important principle is understanding that consistency in trading comes from behavior, not outcomes. Many traders believe that consistent profits come from finding the perfect strategy or the perfect entry, but in reality, consistency comes from executing the same process repeatedly with discipline. Your behavior determines your results over time. If your behavior is inconsistent, your results will be inconsistent. regardless of how good your strategy appears to be. This is why discipline is often more important than knowledge. Discipline in trading means following your process even when it is uncomfortable. It means waiting when there are no clear opportunities. It means accepting losses without trying to immediately recover them, and it means avoiding impulsive decisions driven by emotion. This is where many traders struggle. They understand what they should do, but they fail to do it consistently. This gap between knowledge and execution is what prevents progress. Building discipline is not about forcing perfection. It is about creating habits, small repeated actions that align with your framework. Over time, these actions become automatic and consistency improves naturally. It also requires honesty. You must be willing to evaluate your behavior objectively, not based on whether a trade made money, but based on whether it followed your process. This level of self-awareness is critical. When discipline becomes part of your approach, trading becomes more stable. You are no longer reacting to every movement. You are executing a plan, and that shift from reaction to execution is what leads to long-term consistency. As you continue developing, it becomes important to understand the role of patience at a deeper level. Patience in trading is often misunderstood as simply waiting, but it is far more than that. It is the ability to do nothing when nothing should be done, and to act decisively when conditions are right. Most traders struggle with inactivity. There is a natural urge to be involved, to take trades, to feel productive. But in trading, activity does not equal progress. In fact, excessive activity is often a sign of poor discipline. The best opportunities in the market are not constant. They appear when multiple factors align. Direction, timing, and conditions must come together. When they do, the trade becomes clear. When they do not, forcing a trade introduces unnecessary risk. Patience allows you to avoid low-quality situations. It keeps you focused on high-probability setups rather than reacting to every movement. This alone can significantly improve performance. It also enhances confidence. When you know you are only acting on strong conditions, your decisions feel more controlled. You are not second-guessing every move because your criteria for action is clear. Patience is closely linked to trust in your process. If you trust that your framework will identify opportunities over time, you do not feel the need to constantly search for trades. You allow the process to guide you. This is where simplicity becomes discipline. You are not adding complexity to find more trades. You are refining your approach to take better ones. And over time, that shift in focus leads to more consistent outcomes. Another key aspect of simplifying trading is understanding the difference between reacting and responding. While they may seem similar, they lead to very different outcomes. Reacting is immediate and often emotional. It is driven by fear, excitement, or frustration. When traders react, they make decisions based on what just happened rather than what makes sense within their framework. Responding, on the other hand, is controlled and deliberate. It is based on analysis, structure, and alignment with your process. When you respond, you are not ignoring market movement, but you are interpreting it before acting. This distinction is crucial because the market is designed to create emotional responses. Sudden movements, volatility, and uncertainty can easily trigger impulsive decisions. Without awareness, it is very easy to fall into this pattern. Developing the ability to respond rather than react requires practice. It involves slowing down your decision-making process even in fast-moving conditions. It means taking a moment to assess whether a situation aligns with your framework before acting. Over time, this becomes a habit. You begin to pause naturally before making decisions. This pause creates space for logic to replace emotion. When this shift occurs, trading becomes far more controlled. You are no longer being pulled in different directions by every movement. You are maintaining a consistent approach regardless of what the market is doing. This level of control is what allows traders to remain stable over time. It reduces mistakes, improves decision quality, and reinforces discipline. And ultimately, it is what separates structured traders from those who remain reactive. At this point, the simplicity of trading should be fully apparent but also properly understood. It is not simple because it is easy. It is simple because it can be broken down into clear logical components that can be applied consistently. You understand that trading is based on relative strength. You understand that movements are driven by capital flows and expectations. You understand the importance of timing, risk management, and market conditions. And you understand that consistency comes from process, not outcomes. What brings all of this together is execution, because knowledge without execution has no value in trading. The ability to apply what you know repeatedly and with discipline is what determines your progress. Execution is where simplicity is tested. It is easy to understand concepts in isolation, but applying them in real time requires focus and control. This is why building a structured process is so important. It guides your actions even when conditions are uncertain. As you move forward, the focus should not be on adding more information. It should be on refining what you already understand, improving clarity, strengthening discipline, and building consistency. This is the transition from learning to performing, and it is where most traders either begin to progress or remain stuck. Those who continue to refine their process, manage their risk, and maintain discipline gradually build an edge, not through complexity, but through clarity and consistency. And that is the essence of trading when it is truly understood. As you move into a more advanced level of understanding, the focus shifts from simply applying a framework to thinking like a professional within that framework. This is where decision making becomes more refined, more selective, and more deliberate. Professional traders do not approach every opportunity in the same way. They constantly assess the quality of a setup. Not all trades are equal, even if they meet basic criteria. Some offer stronger alignment, clearer direction, and better conditions. Others are weaker, less defined, and carry more uncertainty. This distinction is critical because taking every possible trade leads to inconsistent results. The goal is not to trade more, it is to trade better. This is achieved through selective thinking. Before committing to a trade, a professional mindset asks a deeper question. How strong is this opportunity relative to others? Is there clear alignment between macro conditions, market behavior, and timing? Or is the setup marginal? This filtering process reduces unnecessary exposure. It keeps focus on high quality situations rather than average ones. And over time, this selectivity improves overall performance. It also reinforces patience. When you know that not every setup is worth taking, you become more comfortable waiting. You no longer feel the need to participate constantly. This is where trading begins to feel more controlled. You are not chasing opportunities, you are choosing them. And that shift in control is what defines professional level thinking. Another defining characteristic of professional traders is how they manage uncertainty. At no point does uncertainty disappear from trading. What changes is how it is handled. Beginners often try to eliminate uncertainty. They search for confirmation, indicators, or opinions that will make a trade feel certain. But this approach leads to hesitation and inconsistency because certainty never truly exists. Professionals take a different approach. They accept uncertainty as part of the process. Instead of trying to remove it, they manage it through structure and risk control. This creates confidence, not because the outcome is guaranteed, but because the downside is controlled. When risk is defined, uncertainty becomes manageable. This also allows for clearer decision making. You are no longer waiting for perfect conditions. You are acting when the balance of probability is in your favor, even if uncertainty remains. Understanding this changes how you view the market. Instead of seeking certainty, you focus on probability. Instead of avoiding risk, you manage it. And instead of hesitating, you execute based on structure. This mindset creates stability. It removes the emotional need to be right and replaces it with a focus on making good decisions consistently. And over time, that consistency is what leads to reliable performance. At a more advanced level, trading becomes less about individual trades and more about sequences of trades. This shift in perspective is subtle but extremely important. Most traders focus heavily on the outcome of each trade. They celebrate wins and dwell on losses, but professionals understand that no single trade carries significant meaning on its own. What matters is the performance across a series of trades. This is where the concept of an edge becomes clear. An edge is not something that guarantees success on every trade. It is something that produces a favorable outcome over time when applied consistently. To benefit from an edge, you must allow it to play out across multiple trades. This requires discipline and patience because short-term results can vary. Even a strong edge can experience periods of losses. This is why emotional control is so important. If you react to each individual outcome, you disrupt the consistency needed for your edge to work. Instead, you focus on execution across a series. You apply your process repeatedly, manage risk consistently, and allow the probabilities to unfold over time. This approach reduces pressure. You are no longer relying on any single trade to succeed. You are building results through consistency. And when you think in sequences rather than individual outcomes, your mindset becomes far more stable and professional. A key part of professional thinking is understanding when not to trade. This may seem counterintuitive, but it is one of the most powerful skills you can develop. There are times when the market does not offer clear opportunities, conditions may be uncertain, direction may be unclear, or multiple factors may conflict. In these situations, the best decision is often to do nothing. For many traders, this is difficult. There is a constant urge to act, to find something to trade, but acting without clarity introduces unnecessary risk. Professionals recognize that capital is a resource that must be protected. Every trade carries risk, so that risk should only be taken when there is a clear reason to do so. This creates a disciplined approach. Instead of forcing trades, you wait for conditions that align with your framework. When those conditions are not present, you preserve your capital and your focus. This also improves decision quality. When you are selective, each trade is taken with greater confidence and clarity. You are not spreading your attention across multiple uncertain situations. Learning to stay out of the market is just as important as knowing when to enter it. It reflects control, discipline, and a clear understanding of risk. And ultimately, it is one of the habits that separates consistent traders from those who struggle. As everything comes together, the final layer of professional thinking is self-awareness. This is often overlooked, but it plays a crucial role in long-term success. Trading is not just about understanding the market, it is also about understanding yourself. Your tendencies, your reactions, and your behavior all influence your decisions. Without self-awareness, it is easy to fall into patterns that undermine your performance. Overtrading, hesitation, impulsive decisions, and emotional reactions are all examples of this. Developing self-awareness allows you to recognize these patterns. You begin to see when you are deviating from your process, and once you recognize it, you can correct it. This is where continuous improvement happens, not by constantly changing strategies, but by refining behavior. Small adjustments in discipline, patience, and execution can have a significant impact over time. It also reinforces accountability. You take responsibility for your decisions rather than blaming the market. This mindset is essential for growth. When self-awareness is combined with a structured process, trading becomes a controlled activity. You are not just reacting to the market, you are managing your own behavior within it. And that is what ultimately leads to consistency, not just understanding the market, but operating within it with clarity, discipline, and control. At this stage, the focus shifts from understanding to application, because no matter how clear the concepts are, progress only happens when they are applied in a structured, repeatable way. This is where simplicity proves its real value, by allowing you to follow a clear sequence without hesitation or confusion. The process begins before any trade is even considered. You start by assessing the broader environment, which currencies are showing strength and which are showing weakness. This is not based on a single data point, but on a combination of factors that point in the same direction. Once that is established, you form a clear directional idea. You are not guessing, you are aligning with the relative difference between two currencies. This becomes the foundation of the trade. The next step is waiting. You observe how the market behaves in relation to your idea. Does it support your view or contradict it? This stage requires patience because not every idea leads to a trade. If the conditions begin to align, you move to execution. The trade is entered with a predefined level of risk. There is no adjustment based on emotion. The decision has already been made through your process. After the trade, you step back and review, not based on profit or loss, but on whether the process was followed correctly. This reinforces discipline and highlights areas for improvement. This step-by-step approach removes randomness. It turns trading into a controlled activity rather than an emotional one. And over time, this consistency in application is what produces consistent results. To make this practical, it helps to think through how a complete trade idea develops from start to finish, not as a theory, but as a real sequence of decisions. It begins with identifying a clear imbalance. One currency is supported by stronger economic conditions or expectations, while another is weaker. This creates the initial idea. Next, you consider whether the market is already reflecting that imbalance. If the move has already happened, the opportunity may be limited. If not, there may be potential for further movement. You then observe how price behaves. Is it moving in line with your idea, or is it struggling? This helps determine whether conditions are aligning or not. If alignment is present, you define your risk. You decide how much you are willing to lose if the idea is wrong. This step is critical because it ensures that no single trade can cause significant damage. The trade is then executed with clarity. There is no hesitation because each step has already been considered. The decision is structured, not impulsive. Finally, the outcome is reviewed objectively. Whether the trade wins or loses, the focus is on the quality of the decision-making process. By thinking through trades in this way, you begin to build consistency. Each trade follows the same structure, reducing variability in behavior. This is how trading becomes repeatable, not by predicting outcomes, but by applying a clear process from start to finish. As you apply this approach over time, patterns begin to emerge in your own behavior. This is where refinement becomes important, because improving as a trader is not about constant change, but about gradual optimization. You may notice that certain types of trades work better than others, or that your timing improves when you wait longer for confirmation, or that your performance declines when you take trades outside your framework. These observations are valuable. They provide feedback that can be used to refine your process. Small adjustments, applied consistently, can lead to significant improvements over time. It is also important to recognize that progress in trading is not linear. There will be periods of improvement, followed by periods of difficulty. This is normal. What matters is maintaining consistency in your approach during both phases. Refinement requires patience. It is not about making dramatic changes after a few trades. It is about observing patterns over time and making measured adjustments. This is how a simple framework evolves into a personalized process, one that reflects both the structure of the market and your own behavior within it. And as this process becomes more refined, your confidence begins to grow, not from outcomes, but from the clarity and consistency of your approach. Looking back, what once seemed complex has now been reduced to something far more manageable. Trading is no longer a collection of random ideas or disconnected concepts. It is a structured process built on clear principles. You understand that currencies move based on relative strength and expectations. You understand that timing and behavior matter just as much as direction. You understand that risk must always be controlled and that consistency comes from process rather than outcomes. These are not advanced secrets, they are fundamental principles. But when they are applied correctly, they create a powerful framework for decision making. The simplicity comes from organization. Each concept has its place, each decision follows a structure, and each trade becomes part of a larger process. This is what allows traders to move from confusion to clarity, from inconsistency to discipline, and from reacting to the market to operating within it with control. The goal was never to remove complexity entirely. It was to organize it in a way that makes it usable. And once that is achieved, trading becomes far more accessible. What matters now is application, taking what has been understood and applying it consistently over time. In the end, the simplest way to understand trading is to recognize that it is not about finding something complicated. It is about understanding a few key principles deeply and applying them with discipline. You are comparing strength and weakness. You are interpreting expectations. You are aligning with conditions when they make sense, and you are managing risk at all times. Everything else is secondary. Tools, strategies, and techniques can support your process, but they do not replace it. As you continue your journey, the focus should remain on clarity, avoid unnecessary complexity, refine your thinking, strengthen your process, and most importantly, maintain discipline in how you apply it. Because success in trading does not come from knowing more, it comes from executing better. When you reach that point, trading no longer feels overwhelming. It becomes structured, controlled, and purposeful. And that is the real objective, not just to understand trading, but to operate within it with confidence, consistency, and a clear sense of direction. If this has helped simplify your understanding, make sure to like, comment, and share your biggest takeaway, and subscribe for the rest of the professional trading video series.